Hello and welcome to India Market Open, one of the most important events that we were awaiting, or rather markets globally were awaiting, is finally behind us. The FOMC meet as on expected lines keeps rates unchanged and opens the door to rate cuts in 2024. Global markets, Niraj and Tamanna, are cheering this morning.
As they should, right? I mean, frankly, with the fall in yields below 4%, and the FIs sense this because there was a large buying number yesterday. I think risk assets are celebrating, and maybe rightly so. I think the question is that we'll have a pop-up for sure today, and we'll talk about that in the trade side for sure. The question is, can day traders make the most of something like this after a significant bump up that we'll see on open itself?
In fact, let's have a look at that. Pull up GIFT Nifty for us. So, Niraj, while you say that Asian markets are not all green, so you've got Hong Kong and Japan that are trading slightly subdued. Now, Japan, of course, is a market, and Tamanna, you can talk about that in more detail. It's an exporter-driven market. So if the dollar has fallen off, Japanese yen is looking stronger, which is not looking good for exporters in Japan. But quick check on GIFT Nifty, and then, of course, you can take us through all the global action this morning. It's actually flat, guys. No pop-up, at least on GIFT Nifty this morning.
So the way I would put it is Jerome Powell has become a Santa Claus of sorts. He's put exactly what was expected in the stocking, and that is something that markets are going to like. He also, like a good Santa, has made sure that you have to behave yourself if the gifts continue to come. So the way I would put it is he has not taken rate hikes off the table. He has said, for now, we are perhaps pausing your rate hikes, but there's no guarantee that we'll not hike rates again. We'll watch the data. The celebration is because of the Fed dot plot. And let me just quickly go through the top global stories overnight to make sense of what has happened, in case you missed it, in case you were, as you should be, sleeping through the night and are now watching the India market open to figure out what happened. So, number one, the Fed has paused rates for a third straight time. They've indicated that there will be 3 rate cuts in 2024 up to 75 basis points. Now, what do I mean indicated? Did they come and say in their document we will cut rates? No. This is based on the Fed dot plot, which is basically a graphical representation of what all Fed members think. And that is telling us that this could happen. Well, the Dow reacted very, very positively, a pop-up of 500 points, and closed above 37,000 for the first time. Oil prices rose as well in anticipation. So Brent was up about, rose up $73 to a barrel. So that was the positive kind of light on it. And as Samina said, that Asia is mixed, but the cues are very positive. The question is, what does this mean? Is the kind of run-up we've seen actually, now credible? Does it mean that it will continue? So Jeff Dennis is joining us this morning on the show, and he's an independent emerging market commentator. Jeff, very good morning. Tamanna here. Great to speak to you on NDTV Profit on a day when we finally have the decision that was priced in, which was anticipated. Now, the simple question is that all of this optimism we've been seeing on the street, on Wall Street, was it the right call? And has it already been priced in?
To leave rates unchanged was undoubtedly the right call. I mean, I think there's sufficient amount of uncertainty about the real economy, and obviously a lot of optimism that inflation is going to continue to fall over time, that leaving rates unchanged was the right thing. I think the thing that surprised everybody, of course, has been the switch of the dot plot to 3 rate cuts in 2024. Now, we don't know when those are going to be. My view has been for a while that probably won't happen until the second half of next year. And I think the market was excited by that, even though, of course, the market itself has been thinking about perhaps more rate cuts than 3. But I think the fact the Fed is now moving in that direction, moving towards the market, is what's really driven this big rally in risk assets over the last, I guess, 9 hours or so, 8 hours or so. And I think the Fed did the right thing. They've talked about rate cuts. They're not getting too excited about them. They're certainly giving you a real suggestion that if the inflation numbers turn up again, they may have to raise rates again. And they're really pointing, I think, to rate cuts when they come, probably coming later in the year. So I think all round, Powell has got it right this time.
Right. Now, Jeff, in terms of the commentary from Jerome Powell, which was, I would say, sobering to the kind of euphoria that we've been seeing, saying that, hey, I'm not promising rate cuts, I'm not promising there won't be any rate hikes, it depends on the data coming in. How do you think that is being looked at?
I think that the market, I think it's probably a slight overreaction by the market to what he actually said. And I think the most important thing is not so much what he said, because some of the rhetoric was still quite cautious and quite, even-handed, let's put it that way, in terms of the scope for early rate cuts or the risk of yet higher rates. But I think that at the end of the day, as I say, I think they have done the right thing here because they're leaving their options open, and their options should be left open because we still need to see further rate declines. But for me, the market's perhaps a little bit overreacted here, and maybe we just got a little bit too exuberant. Nice move happening in emerging markets as well in the Asian session. So, the index is up over 1%, which is very, very welcome. So a little surprised quite how euphoric everybody is. But for me, the reason why that is because we are now, the Fed itself is now penciling in rate cuts in 2024, and that's very important.
Jeff, Niraj here, morning or rather good evening to you. Is it my imagination or are you sounding a bit more circumspect than what you sounded off the last time?
No, I don't think so. I'm just saying that, I think the specific reaction perhaps was overdone, potentially slightly overdone compared to what Powell said, and also compared to what they've done, because there's still a lot of uncertainty. I am bullish. Please do not, don't doubt that is my view. I'm constructive. This has been a very big move today. Later in the day in the US, and some markets are moving nicely in Asia, not all markets, as you said. But at the end of the day, we've had a very good run, and these things do pause for a period of time. What's been the big driver here has been bond yields, which of course have now dipped below 4% for 10 years. So I'm definitely in the mode of buying any sell-off, adding to risk, but being somewhat cautious about it because of the extent to which the markets have moved already. EM has been massively disappointing, and the reason for that primarily is China, frankly, and also because the dollar has been, until today, I guess, disappointingly strong for emerging market assets to do well. So we need to see China doing better. We need to see further declines in the dollar. But overall, if we are heading into a situation now where rates have definitely peaked, which I think they have done, and that we will get some later next year, I think it's still correct to be bullish about the risk, the equity space. Bonds are somewhat bullish, the dollar probably bearish, but don't get carried away. We're not sort of getting every day. It was a very, very strong reaction and possibly an overreaction in the US today to the specifics that happened today.
And the backdrop to me are being skeptical about what Jeff was saying, that he joins us every time after the Fed speak.
Yeah.
And all through the last 4 meetings, he's been constructive on what Indian markets and EMs could do, which is asking that is he being a bit more skeptical than what otherwise he sounds.
Jeff, then let's get down to what this means for emerging markets like India. With term premium going down, that's the anticipation. Emerging markets usually become beneficiaries of big fund flows from developed markets. B, in terms of timing, so of course we will get the easy equity money that starts coming into India, but when do you anticipate the serious pension long-term money making its way into emerging markets like India?
I think the key here, as always, and I always talk about this, and I think it is the most important thing, is further evidence of dollar weakness. And this is why the dollar's decline here has obviously been a big driver of what's going on in Asia today. And I think if the dollar were to continue to decline, I think there's a good chance that will be the case because the Fed is giving us this signal that rates are, hopefully at their peak. I'm going to give you a couple of data points here. If you strip out China from the emerging markets this year, EM is up just over 10%. If you strip out the US from the developed market index, DM is up slightly less than 10%. So actually, the emerging markets have had a good year if you exclude China. And of course, the US has been by far the best performing, across the big developed markets. And so I think the difficult performance of EM this year is being dominated to a certain extent by the comparison with the US and the drag on the index that we're getting from China. So what will really help emerging market investors overall is if China were to turn itself around. That's a whole separate debate. But as far as India is concerned, where I remain constructive over the long term because of growth, because of the earnings growth, I think the election will probably go well next year with the BJP victory, and that will be welcomed by the market. Valuations, of course, are always a challenge in India. You've got a somewhat challenging budget situation, but generally real interest rates are not too high. They're going to be able to come down gradually as well. So I think if you were to see this move generally from developed markets into emerging market assets, the key driver of that's going to be benign bond markets in the US. The Fed gets to the peak. Perhaps people get nervous about the US because of valuations. And most important, all that translates into a weaker dollar. And I still think the dollar's heading towards 115 against the euro, probably by mid to late 24. And I think that's going to bring money back into the EM. But my goodness me, we need to see China doing better for the index to really do as well as it should be doing.
Right. Thank you, Jeff. Great talking to you this evening. Have a good one, and we'll speak to you soon. In the meantime, Asian markets are looking good. Hong Kong is leading the rally across Asia with gains of over 1% across the board. Japan is under pressure. Exporters are doing badly this morning, and also the financial stocks in Japan are seeing some selling this morning ahead of the Bank of Japan meet later next week, early next week actually. But that's of course the global setup. The dollar did sell off. We are expecting the rupee to see a gap up. Indian bond yields on the 10-year could also get closer to levels of 7%. But all eyes on trade this morning. We took a little bit of a break, a little bit of a consolidation over the last couple of days, but the booster we were looking for this morning is right here on a platter, Niraj.
Yeah, but and Samina, but the second half of trade yesterday also, there was a bit of a pull back from the lower level. So that was a great piece of news, and more so for the broader end of the spectrum.
Just like you see, Mr. Market always knows, and Mr. Market knew yesterday.
Yeah. 4,700 crores of FI buying too. But just that, it was a cross-asset rally in Wall Street. Very likely will power our markets. I know GIFT Nifty is saying this, but for people who look at SGX still very, very closely, that's still suggesting a bump up of 200 points, so you don't know what will happen there. Very likely that somehow it seems like it's very difficult for India to miss this uptick in US and Asia by and large. And, quant indicators are stretched. They are talking about being in an extreme greed zone, but who knows, with the falling yields, that might well continue to be the case. We've been sounding like a broken record talking about financials being the key ones. We saw what happened to power financiers yesterday. We saw the PSU banks yesterday. That sector is in a frenzy. But, just looking at the earning multiples and the commentary from the companies across that space, the earnings growth and the execution growth is so pronounced that some of these valuations which are looking stretched right now might start looking okay. For a wind company or a wind turbine company to say that we've done 220 gigawatts right now, but we'll do another 150 gigawatts right now, but we'll do 350 gigawatts additional in the second half, top it up with another 100 megawatts in the next year.
Yeah.
Some of these stocks might look very cheap once the execution kicks in.
Right. We'll also look at those because that is the broader market activity. Like Niraj said, we are expecting a gap up, and that should play out in early hours on trade. We will be, of course, joining the rally that global markets are doing this morning. But I think the currency market and the bond market will be even more excited. So you will get that gap up on the 10-year. We closed at 7.3 yesterday, and opening closer to 7 cannot be ruled out in early trade. You've also got the currency markets. The dollar did correct sharply in overnight trade. The dollar index is sub 103. The rupee could be seeing some strength in early minutes of trade. Well, let's take you through a few stocks that we're watching out for in today's session. So a bunch of smaller names I'll pick up on and then pass it on Tamanna and Niraj who'll track the other big stocks to watch out for. Fusion Microfinance, and this was reported by a few agencies. Warburg Pincus, I believe, is looking to offload 9.25% stake in the company through a block deal. The deal is valued at 5,000 odd crores, the floor price of 535 rupees. This counter will get a gap down in early minutes of trade and may continue to remain under pressure as we go through the day. NBCC, a stock worth taking note of. They've received an order to the tune of 1,500 crore rupees. Usually companies like NBCC get a pop-up on order wins, and we will see that play out in today's day of trade. The order is for construction of 1469 warehouses and other agri infrastructure across India. Well, apart from that, GMM Pfaudler, the stock has been under pressure over the last couple of months. In fact, it's one of the few names that it's actually declined 20% in the last 3 to 4 weeks. The news here is that the promoter family is acquiring 1% stake at 1,700 rupees a share. This is largely being done to, of course, keep a little bit of a flow for the counter and to support prices at these levels. At 1,700 rupees coming at a premium just goes to show that the founder is, of course, very optimistic and is doing this to maintain faith of investors. Apart from that, they will be the largest investor. Their shareholding currently stands at close to 26% in GMM Pfaudler. So those are the few names I'm tracking this morning. But Tamanna, the list goes on.
Absolutely, the list goes on. I just want to add one point before I get to the stocks on my radar. And Niraj was talking about FII buying. So 4,700 crores odd is what they bought today. But DIIs have also been selling strategically. So about 958 crores was sold in yesterday's market. And we have to see what kind of a play out we see today. Because, again, a bit of confusing cues. SGX is showing a gap up, GIFT Nifty is showing a flat start. We've been having an internal debate over here in the breaks on whether we're going to see a sell-on news. In fact, there's a bit of a wager going on between Niraj and Samina. But let me come to the specific stories, and I'm going to take off from something Niraj has been saying and has been a current theme, the financing of India's green energy push. And I want to start with State Bank of India on my list because the lender will be signing a 70 million euro line of credit with KfW, that's German Development Bank, for supporting solar PV projects in India. IRCTC is another one we could look at, and very interesting to see how government-run and government-allied companies have been at the forefront of all of these news stories like the NBCC order flow. So IRCTC is planning a major expansion into catering outside the railway business. And of course, they're known as the railway caterers, but they've also signed MOUs with various government and autonomous bodies, including defense establishments, and they're going to commission 15 more catering units. Religare is maybe one we should keep an eye on, Religare Enterprises, because SEBI has suspended the company's unit, Religare Commodities, for 3 months. So we'll see if there's an impact there. And Biocon had a bit of news coming in. We'll have to see whether there's any reaction positively or negatively, but essentially their unit, Bicara, has completed $165 million funding. It's a Series C funding. They are going to use that money for their cancer candidate, which is a BCA 101. And post that funding, Biocon's own shareholding will drop below 20%. Just a quick word on IPOs, because fundraising and IPOs is something where an opportunity is being seen by Indian investors. They're being lapped up. So an interesting one opening today, Inox India. It's a cryogenic tank maker, and their issue opens today. They're planning to raise about 1,400 crores odd in an OFS. It's an offer for sale, and the price band is 627 to 660 rupees. DUMS, of course, the IPO opened yesterday, the pencil makers, but they've been oversubscribed by about 6 times, 5.72 times. The retail segment has been subscribed also quite aggressively. India Shelter Finance Corp was also fully subscribed on day one, while retail investors subscribed 1.89 times. So those are some of perhaps the action pieces that we should look at. But Niraj, in terms of sectors, I just want to get a sense from you. The Fed decision and this being exactly in line, does it do anything for beleaguered IT companies or any kind of impact there on banking finance, or is it just going to be our own theme that you think will play out?
I think most people that I spoke to this morning, early morning, said that the continuation of the same, but trading profits, might as well book them out. We probably in a party which started at 3 p.m. In the afternoon, and currently we are at about 1:30 a.m. So great to dance, but dance close to the door. I think that seems to be the message currently.
I like that line.
Yeah, but let's see.
I think tech, like Tamanna said, could see some pressure, imagine, because a stronger rupee is not going to garner well for exporters, right?
But see it from this way, if the outlook on the US economy is improving, and that was what was pressurizing a lot of the tech companies because discretionary spends were coming down, that might be seen maybe as some of a relief.
I mean, if I had to place my bets, I think there'd be some pressure, but that's actually a good point. You could see business getting better if that's the hope.
Yeah, let's wait and watch. But we need to slip into a very quick break, so let's do that. We come back and bring in market voices and the derivative conversation very, very quickly on India Market Open. Andrew Holland of Avendus Capital joins in on the other side. Back with India Market Open right here on NDTV Profit. Let's see how we start off. But Andrew Holland, CEO of Avendus Capital Public Market Alternate Strategies, joins us on the phone line. Andrew, great having you. Thanks for agreeing to do this. Andrew, let's assume we start with a bit of a gap up, even if the GIFT Nifty may not be suggesting that. Is this party starting to look very close to it coming to an end? And on the trading side, would it be prudent to now start looking at a bit of profit booking, never mind what Fed speak has done?
No, I see, Niraj. I think this is the kind of the kind of last, not saying the last leg, but the last kind of thing to drop for markets to move higher now. It's been consolidating around that kind of 21,000 level or just below. But Powell played. Should have been Santa Powell yesterday because he's turned around and everything and talked about rate cuts. So we'll start penning those in probably in the first quarter. So I think our market probably has, in the first quarter from here, probably has another 5% from here.
Andrew, hi, this is Samina here. Just a quick one, and I want to get your perspective on this because usually in market conditions such as these, we do become beneficiaries of fresh inflows. The term premium, like we talked to Jeff about as well, has declined, which means risk-on trade could come back into style in India. What are you expecting in terms of next steps, right? When will you see fresh equity money? When will you start seeing pension funds coming in? And also, more importantly, with the rate differential now coming off, do you think the RBI over the next 6 to 8 months will be forced to cut rates as well?
Yeah, no, I think talking on the RBI, I do think they'll be cutting rates. I think emerging markets have the ability because we're commodities heavy led in terms of inflation, along with food. So if that's under control and coming down, then I think we can be as aggressive as the Fed is in terms of interest rate cuts. So I wouldn't be surprised if you see cuts in the first quarter in the US. We'll see something by the RBI very soon after. So I think that gives the catalyst for our markets. In terms of flows, I think a lot depends on China. I think if China can just stabilize that property market and give confidence back to the investors in that, then I think you'll see a lot of flows going to emerging markets, and of course that will find its way into India. So I think this rally will be led by large caps and banks in India, and then I think that the party will continue for the small and mid caps going into the new year.
Andrew, morning. Tamanna here. We're wondering how markets are going to open because the GIFT Nifty is not looking too excited by Jerome Powell as the rest of the world seems to be, and definitely Wall Street seems to be. Are you seeing a gap up? What is going to be your strategy today after such a big run-up over the last 6 weeks?
Well, fortunately, coming into this, we were long in terms of our funds, so we're positioned for that. But I think we think that this will just be the extra catalyst for the markets to move. I'm not saying all today, but I think in the first quarter of 2024 we will see that extra 5% uplift to market. So near to 22,000 Nifty, I think.
What's going to happen this morning?
I don't think so this morning, but over the few months it will do. Yeah.
Andrew, just very quickly, if on 100% equity allocation, if investors are sitting on that, there are who've stayed out with maybe 10-15% of their portfolio in terms of dry powder, anticipating a correction. We've gone from 18,000 to 21,000, pretty much without batting an eyelid. What do these investors do now? Do you throw in the towel? They're all going through FOMO, right? Do you buy right now, or should you wait on the sidelines, anticipating and hoping that some correction will come our way, and then, of course, you can go out and aggressively pick up equity?
No, listen, there's always going to be corrections in the market, and if that's a strategy you want to play. But I would say this, is that in the run-up to the elections, you usually see a 5 to 10% kind of rise ahead of it. And given the recent base election results, we've had 5% of that rally. So there's another 5% to go before we talk about interest rates. So I would suggest that if you're investing or you're waiting on the sidelines, it's probably time to pick up those sectors or stocks which you favoured.
Right. Thank you very much, Andrew. It's such a pleasure talking to you. Have a good day and a profitable one, and we'll speak to you soon, hopefully in person next.
Thank you very much.
Right, Niraj, Tamanna, it looks like Andrew is optimistic as well. 5% is what he's betting on. Of course,
he's saying not today. We don't know what's going to happen this morning.
I'd be surprised with the 5%.
I mean, in the sense, you're not going to start seeing perhaps a huge
buying coming in, right?
The SGX Nifty.
I think structurally things are looking great. So SGX looking good. GIFT Nifty still not picking up on those cues, but we've got Agam standing by at sharp 8:30 with his F&O data. Agam, so much happening, but let's talk about what you've picked up on in the F&O space.
Yeah, so over the last few days, we saw a bit of consolidation, and a lot of traders took that as an opportunity to go ahead and sell around 21,000. Now, should the Nifty in fact open above the 21,000 mark, there is a chance that there could be a bout of short covering. If there's short covering, it could potentially lead to the indices moving higher. And that's always one of those risks when you in fact go ahead and sell not just the futures but options side of things. But I'm going to start off with the basics. For now, yesterday, we did see a lot of traders square off their positions, obviously because of the uncertainty posed by the Federal Reserve, and that's indicated by the decline in 4% open interest as far as our index is concerned. Well, marginally in the green, but coming down to the Bank Nifty, once again, the picture isn't very different. We are seeing an unwinding of around 4%, even as the underlying remains flat. Now, as I was talking about the options market, let's pull up your maximum open interest, and that continues to remain with the 21,000 call. So now, and given the fact that today is that weekly options expiry, should we see the Nifty open above 21,000, considerably above 21,000, we're going to start seeing a lot of these traders unwind their calls around 21,000. And of course, that said, a lot of the activity will then start shifting higher towards 21,100, 21,200. On the lower end, we have plenty of support around 20,800 as indicated by the open interest accumulation out there as far as puts go. And let's take a look at what's happened and how this change has panned out. So quite clearly yesterday, we did see a substantial increase in the 21,000 mark, as I've been talking about. So based on that, we also talk about stocks and take a look at where we've seen a lot of traction in open interest. So shorts coming in for PI Industries and Apollo Tyres. On the other hand, longs for Concor, TVS Motor Company and Vedanta. And among those stocks, which in fact did see a decline in open interest, short covering seen for Birlasoft, Alchem Laboratories and Dr. Reddy's. On the other hand, longs unwinding in LTI Mindtree along with L&T Technology Services. This is as far as stocks are concerned. The question now is, based on the global developments and how we are stacked up in our own data at the moment, remember FIIs are 58% long in index futures, where do we go from here and what do we do? Let's get in an expert. We have Kush Bora, founder at kushbora.com, joining us at the moment. Kush, good morning and thank you so much for taking the time out. Let's start with your assessment of the benchmarks. Where do we go from here? And how are you employing options specifically, considering your view?
Hi, Agam. First up, a very good morning to you and everyone on the panel and the viewers too. Well, this is how the bull market pullback rallies last, isn't it? Short-lived and shallow. I mean, we were expecting a dip on the Nifty. We got that, and perhaps we'll have to be content with a 200-point dip only. And given the kind of moves that the SGX Nifty is predicting, I think the 21,000 call option writers are in for a bit of a short covering. So I think the indices, will do well from here. The pullbacks will be, as I said, shallow and short-lived. But from here on, the risk-reward ratio is not favorable, especially for someone doing plain vanilla, options, because the markets are already in a bit of an overheated territory. While the liquidity-driven momentum will take the markets forward, it just makes a very difficult case for buying plain vanilla options. Now, that said, since the trajectory is up, I suppose the best way to play the Nifty is through strategies and spreads. So today I've got a bull call spread on the Nifty. Given the kind of short covering rally that we can expect, if the Nifty sustains above 21,000. What you can do, what a trader can do, is buy the 21 December 21,000 call option for about 123 rupees and sell the 21 December 21,300 call option for the price of 28. Now here on, the break-even point is 21095. So if Nifty sustains or closes above this, the traders will be in a profit. The max profit potential on this one is 10,250, and the max loss potential in this strategy is 4,750. So the risk reward ratio is fairly, in the favor, more than 1:2. So I think this is a strategy that can be deployed, given the fact that we are going to open above 21,000, sustain above that for some time. Looks like we will sustain above that for some time. A short covering rally is due. Bank Nifty, we're slightly more bullish. So in the near term, our target on the Bank Nifty is actually 48,000. Perhaps that is also a trade the traders can consider. But yeah, as I said, pullbacks, don't wait for them. Any kind of dip you get even on an intraday basis should be utilized as a buying opportunity.
Just a follow-up question on your Nifty strategy. Now, should we see the Nifty open 200 points higher? I reckon the premium profiles for the strikes will change considerably. Based on that, would you want to change your strikes as well as far as your debit spread is concerned, or would you in fact stay with those very strikes here?
Well, excellent question, and that is the risk that traders run when you have a gap up opening at such massive levels, about 200 250 odd points. So what what the traders can do is shift these premiums or shift these strike prices by 100 point each, so 21,100 and 21,400. But what I would say is, don't do it at the open. Give the markets about the initial 20 to 30 minutes. See if there is some sort of a pullback. And if the indices do come back to about 21,100 odd levels, then these strikes are still good to play with.
Right, so a very pertinent point made out there by Kush. Don't go ahead at the opening should we see a sharp surge, at least as far as your first tick is concerned. But Kush, from there on, let's talk about your strategy on one of those stocks. Can you take us through that one?
Sure. So the stock that we've got on our radar for a while now is Siemens. It's been our call in our advisory service also for some time now. And the structure is beautiful. It's completing a rounding bottom, formation. Above 3950, close to 4,000 is where the breakout is imminent. Now this stock has actually underperformed the entire capital goods space, but not because of any business related reasons, slightly more external reasons. Now those reasons are waning out. The stock will continue its momentum and do a catch-up rally. So I think beyond 4,000 the stock will actually gather more momentum. So what you can do, or what the traders can do, is again implement a bull call spread here. 28th December, 4,000 call option for a price of 70. This is the one that has to be bought. And 28th December, 4,100 call option for the price of 41 has to be sold. Now here the breakup is the break-even point is 4,029. If the stock closes above this, the traders will be in a profit. Now the max profit potential on this one is 19,525. And the max loss potential is 7,975. Again, more than 1:2, and the stock, given the kind of momentum, could very well actually close above 41,000 also for this series. So Siemens is our pick for this series, and a bull call spread on this is what I suggest.
Okay, there you have it, guys. Well, two bull call spreads coming in from Kush Bora, one on the index, that is the Nifty 50, and the other one is on Siemens. So watch out for that one. Kush Bora, thank you so much for joining us and taking us through your views on the markets, and with that, handing it over to you all back in the studio.
Well, thanks a lot for that, Agam. Just one quick word. You've spoken to Kush, but you've spoken to others as well.
Yeah.
The key takeaway seems to be that there could be a bit of short covering if the index sustains 100 or 200 points above the 21,000 mark.
Yeah.
Is that right?
The other point that I did want to make was that FIIs in the index futures are currently at 58% long.
From 36% at the start of the series.
And about 2 weeks ago, it was at 12%.
Oh, okay.
So there is a big jump in their long positioning as well. The question is that does this number stay the same, increase a little bit, or do we start seeing some amount of profit taking here?
So that's an interesting stat, because 12% 2 weeks ago, at the start of the December series, it was 36%. Yesterday or day before, it was 57. Now it's moved to 58. So those long positions are very, very high. So interesting to see what happens there too.
Yeah, so a gap up will really look at some new levels perhaps on the Nifty. Thank you for that, Agam. As we prep for market opening in just a bit from now, just to recap, the big story of this morning is definitely all about the Fed, and we have to see how that impacts our opening. GIF Nifty, though not pointing to very exciting cues, and perhaps a muted opening at this point. But let me just quickly go across to Jayesh. Jayesh Mehta, MD and Country Treasurer at Bank of America, on his take. Jayesh, a very good morning. Great to have you here on NDTV Profit, especially on a day when I think the bond markets are trying to make sense of what next. What is your take on the way you are going to see bond markets respond?
Good morning. Yeah, we are basically, ending the year with a happy note. Especially market up was kind of pricing the 3 rate cuts for 24. But day before inflation, markets kind of always vary about one day. They are looking at 3 to 4 cuts in 2024, and one day they are worried about inflation. So that was the day before. But yesterday, in the Fed meeting, the most important point is they first time discussed anything about cut. And so therefore, now definitely any rate hike or anything is really off the table. And market now has started, some of them have started pricing 4 rate cut in 2024, and which is kind of looks good. So yeah, it's definitely going below 4. Now looking at that for Indian market, definitely good for the asset class, whether it's equity and U.S. equity or Indian equity. But for the Indian bonds, yes, we would see some, falling yield today, but that would be limited, maybe 3-5 basis point. Maybe it might open 5-7 basis point lower, but then may consolidate at 4 to 5 basis points, because we really haven't gone up much also. And we do expect the first rate cut, if it happens in India, not before the Fed rate cut.
And when do you think the first one is then? The Fed rate cuts. Everyone's trying to do this sort of body language scanning for when the first rate cut is from Jerome Powell. When, in your estimate, Jayesh, does that series of rate cuts start?
So most of us were expecting from June next year, but after yesterday's statement, some of them have officially moved there to March 24 rate cut. But it's too early to say. I also wouldn't not really put a number, because like some researchers who were there now, we have to see all the other researchers saying, but most of them were at June 24, bearing 90% was at June 24. Now, of course, after yesterday's night statement, a lot of them would have moved to March 24. Now, what's the tilt and the percentage, I don't know. But honestly, I would keep my mind open for both March and June.
Jayesh, let's talk about what this means for the dollar-rupee pair. A few months ago, when emerging market currencies were in a free fall, the rupee held out largely due to intervention from the RBI. Now, with today's gap up opening that's expected in the local currency, what is the trading range, A? And B, do you think the RBI will come in and defend any particular level? Because this free fall is not, or the free gain is not going to go too well down with exporters.
So I think yesterday we saw the law, right, the 80-40, and, but now because of the dollar index also going around, we might see some retracement from there. Maybe we may see 83.20 or 10 today, 20 or so. But I think for us, it's good for dollar index. Somehow last few times we have seen when the dollar index is depreciating, but because of that, we are not really changing, and we are actually depreciating against pounds and sterling, pound and euro, right? So that's where the challenge is. But we have to look at some flows. Hopefully by January or so, we will see some flows coming in, both on FPI bond and FPI equity. And I do expect that we go below 80 to 50 by March or so.
Very quickly, Jayesh, then what are you advising your clients to do? Are you telling exporters to hedge right now, because these are probably going to be compelling levels at least for the next 6 to 8 months? And what are you telling importers to do? Keep open positions? Just so that I get the sense of what people should be doing right now, because it's mixed cues in every way, right, in the currency markets at least. And of course, let's not forget, you've got JP Morgan's index inclusion, so passive money will start ticking in from June as well.
So I think most of our clients who are on program basis, they are not taking a call and still doing it what they planned as per the program, and which is always work, right? Like you do it in a disciplined way, in a certain way, you keep on doing it. But yes, the volumes have been lower because what's happening with U.S. rates being also higher. And of course, you have 6 months to bring money. Plus also the forwards is not lucrative for both sides, right? So it's not expensive for importers nor exporters. So kind of market volume has kind of gone off dramatically from the market. So both of them are not really hedging 100% because, the kind of premium one has to pay or receive and the kind of volatility which is there in the market, it does not really, excite them to hedge so aggressively. So that's not good for the market makers, but from a country perspective, it's not a problem.
Sure. If we do get a gap up on the rupee, I just want to quickly understand from you, will you tell importers to hedge just for the day? So just a trading strategy in terms of what you're looking to do. And also, I know you said that there will be a defense coming in at 83.40, but if you can just give me that trading range for the day, that'd be very useful for our viewers.
So looks like it will go down below 20 or 30, I don't know. But definitely it's not crossing 83.40 today. So it feels like it would be closed down. The closing would be maybe 20, 25 or so. So from that perspective, I don't really see it's going to 83.41 even during the day.
Bet on the 10-year coming down to 7? Is that being too ambitious?
You might see some trade at the opening, but as I said, like the closings would be maybe 3 basis points, 3 to 4 basis points lower than yesterday.
Okay, Jayesh, great having you. Thanks much for taking the time out and being with us this morning. Really appreciate your time.
Thank you, Niraj.
All right, that's a view from Jayesh Mehta of BofA Securities. Now, let's go across full tilt to equities. 30 minutes to the pre-open session. Devin Choksi, MD of DR Choksi Securities, excuse me for that. And Rahul Sharma, Director and HOR at JM Financial, join in on the show. Gentlemen, both of you, thank you so much for taking the time out and being with us. Straight off the bat, let me get the trading range first, and then we'll get in the fundamental view from Devin Choksi as well. Rahul, you were constructive sometime when we crossed that 20,300 mark. You predicted some levels around these levels. What next from here after the potential gap up that we have in store? What do we do next?
Very good morning, Niraj. Thanks for having me on the show. Well, FOMO has now got converted into ROMO, which is regret of missing out, and that is exactly what we are seeing in the last 2.5 weeks. Around 40,000 crore worth of equities being bought in cash by the FIIs. The decadal short positioning that we had in index futures is now net longs. So clearly goes to show that there are a lot of late longs into the system. 21,000 as a psychological level, as something that we were expecting as a target for the Nifty has been done and dusted. Having said that, I think, ideally a correction is, the best way to go about. But considering the way US markets have performed last night and the indicative opening by the GIFT Nifty, there's a good chance that we create a new all-time high, yet another all-time high today, tomorrow. And, we see a round of, momentum opportunities in the market. I think from here, market is more, it's better to be stock specific. It's better to focus on the mid and small cap where, we expect the momentum to remain high. If there is a meaningful correction in the next few trading sessions, I think that would be a good opportunity to re-enter. But unless that happens, I think it's best to, go for the bottom-up approach where, individual stocks which are relatively better placed in terms of risk reward, pick them and go on the long side.
Good morning, Rahul. You've given us a great line, FOMO replaced by ROMO. I really like it. It's going to be the new header. And Devin bhai, so good to see you as well. But I'm just going to take one quick follow-up from Rahul Sharma before I come to Devin bhai. And Rahul, the question is about strategy. The concern is that now that the event that was being anticipated is behind us, what do you do next? What would be your advice there?
Yes, so we're looking at a couple of sectors. So, 12 months back, we had the public sector enterprise index giving a decadal breakout, and we've seen the last 12 months literally dominated by the public sector enterprises. Something similar is happening on the reality index, which has given a 14-year breakout. Now, this breakout has taken place in the last few weeks, but I think the next 12 months we could see this sector do extremely well. So, this is one area which remains very hot going ahead into the next year. And secondly, banks, the pain point for the market, they are not anymore. The large cap banks have done well. The smaller rung banks or the tier 2, tier 3 banks are the ones who are expected to play catch up. So these are two areas of the market which look relatively good. And third, which is the IT sector, which we feel that should do extremely well from here. It's the index heavyweight. Secondly, it is the only sector which has an extremely good ratio of least risk and maximum headroom. So IT should be the pick if you are looking for big gains on the upside over the next 3 to 4 months. Whereas it comes to momentum trading, I think banks should do well. And when it comes to a slightly longer, 1 year and above, I think reality is the space to be in.
Naveen bhai, very good morning. Welcome to NDTV Profit. Great to have you on the show. Just your first take of whether the last sort of question mark or the last sort of wrinkle has now been ironed out after the Fed announcement yesterday, and from here on, how do you see the markets going? Are we going to see a lull because of December end and then a pickup post January?
Yes, good morning and glad to be on the show. I think the Fed is very clear. In our analysis, generally the rate hike cycle pulls off after 6 quarters of the hike. And then after, I think, another 2 quarters, I think they would probably go on the sidelines. Subsequently, they get into the rate reduction mode, and that is what is expected come calendar year 24. And I think one would probably be expecting that somewhere in the first quarter of the calendar year 24, we should be seeing the fall in the interest rates, in the Fed rates. Given that kind of possibility, which is, I think, fairly understood by the financial market as well, I would rather like to think that the flow to equity would probably increase. Flow towards spending on the infrastructure would increase. And including in America, where I think they're putting big time money behind infrastructure, particularly on building the railways. I would think that the amount of cost of money, I think, will have to be brought down. Of course, nothing could be, I think, talked about pre-COVID kind of a scenario, wherein I think you had, I think, almost near to 0% rate of interest. I think that scenario is not talked about. But the fall in the rate of interest, the fall in the yield, bond yield, I think is definitely on cards. In calendar year 24 rather, I think would see the flow of money into different other asset classes, including the asset class which is equity, where the significant amount of traction is built. So one can remain relatively more confident about India attracting larger flow, given the kind of program that we are implementing both on the industry side through the PLIs and also on the infrastructure side through spending on various items of infrastructure by the government. So this is where probably we remain optimistic and bullish about the possibilities.
Devin, hi, it's Samina joining in as well. Good to see you after many years.
Thank you, Samina. Thank you. Good to see you too.
Devin, you've been fairly constructive on the IT pack. And of course, with indications that the US economy could be sort of seeing some sort of a recovery coming our way, that's of course the positive for IT stocks. On the flip, it will also mean that the rupee might get stronger, so exporters will take a step back. Keeping both those factors in mind, how would you approach the IT pack, and what are the stocks we like? Are you betting big on the likes of a KPIT, LTI, Tata Tech for that matter?
Yes, I mean, I think absolutely spot on. I think even this year, calendar year 23-24 beginning itself, we have been saying that probably I think the worst in the IT is getting over. Largely because of the fact that the world is spending significant amount of money on cloud computing. Most of the Fortune 500 companies, out of which only 30% companies are today on the cloud infrastructure. And the computing is now shifting onto the cloud. Given that kind of a situation across all the industry verticals, be it BFSI, be it healthcare, be it any other vertical, I would think that the amount of spending that the countries and the companies will be making going forward in the global space is going to be huge. Given that scenario, Indian IT companies would probably are sitting on the prospects of winning some of the large contracts, which are going to be long tenure contracts, not going to be 1 or 2 year contracts. They're going to be 5 to 15 year contracts. That's a possibility that we are seeing happening in 2024. And that's the reason for which I think we remain reasonably confident and optimistic about the prospects going forward for the Indian IT companies. Within this space, the one space which remains absolutely sure and a lot of clarity over there is engineering R&D space. And that is where companies like recently listed Tata Technologies or Tata Elxsi, KPIT, for that matter, LTTS, LTIM, Science Technologies. These are few names where I think these companies are systematically going in their respective verticals and winning some of the contracts which are profitable contracts, significantly large profitable contracts. So we believe that I think the opportunity is ripe for staying invested in IT, and correction in the price, particularly in the mid-tier IT companies, would mean a lot of opportunities for investors to compound the wealth at the rate of 20-25% on a yearly basis for the next 5 years.
Devane, Rahul, stay with us. We'll be gearing up for pre-open trade. It's going to be a good start from the cues that we're picking up globally and, of course, on GIFT Nifty as well. We'll take a break. We'll come back with a lot more on the other side, so stay tuned.
Pre-open rates on your screen. I think these will change. Remember, we are likely to start off with maybe 100, 150 odd point uptick. Let's wait and watch if that were to happen. And of course, keep a keen eye out for financials. So that is something that, will be the focal point of the session today. So that's to be kept in mind as well. Also, the other pocket to keep in mind would be the power financiers or the power space at large, because there's some substantial movement that is happening in that pocket too. We'll talk about the brokerage's views on some of the financial names as well, and those will come up too. But just before we get to that, my colleague Mimamsa would be with us to talk about that in a moment. Okay, I'm told Mimamsa is with us already. Okay, Mimamsa is here. Mimamsa, good morning. It seems to be a good, promising morning for the markets, particularly financials. What do you have for us?
Right. So I have a report, Jeffrey's report today from, they are stating that credit cards linked to UPI will expand the opportunity for payments and credit card players. So over the next 12 to 18 months, about 35 million credit cards, which is just 10% of penetration, will lead to $60 billion in payment volumes. Now this can add 20 to 30 million acceptance points and benefit payment platforms like Paytm and SBI cards. Due to better monetization of UPI. Now, even SBI cards can capture a share in UPI spends, but that will depend on the merchant discount rate, because a merchant discount rate on small ticket loans could have a bearing on the cards company given the shift from Visa and MasterCard transactions. But this is also dependent on how merchants are behaving, are accepting, are responding to credit cards on UPI. So resistance by merchants is a key risk to mass scale adoption of credit cards on UPI. Given the UPI linkages to credit card only work on RuPay network, issuance of RuPay cards to existing and new credit card customers is a prerequisite for a meaningful jump in spends. Over to you, Niraj.
Okay, Mimamsa, just one quick thing. So is Jeffrey saying that the space is underpenetrated and there is more to come in the years to come?
Yes, they're quite hopeful on how the credit card industry will change with the monetization of UPI through credit card links to RuPay.
Got it. Mimamsa, thanks so much for bringing us this update. So SBI cards is one cog in the wheel of financials, which seem to be everybody's favorite. Now, I want to come in here I want Rahul to come in here on what to do with some of these financiers which have caught the fancy. I mean, if power financiers were the case in point yesterday, we've seen a clutch of others anyways do well. What do you like within this pocket, Rahul, and particular view on yesterday's key movers, PFC, REC?
Well, if you doubt or ask questions, in the last few weeks, in terms of REC and PFC, you would have missed the rally. That is a kind of dominant up move that we've seen in both these financiers. I think, this is not done yet, because at the end of the day, the volumes are just not drying up. And my sense is, if you are a trader, the best thing to do is, keep booking profits at regular intervals. Eventually, I think, the stocks will reverse. But, at least at this point in time, they don't exhibit any sort of fatigue in terms of their upward nature. Having said that, since you spoke of SBI cards, this is one of those stocks, which has been under pressure. Even in a bull market, this is struggling to find its bottom. So my sense is, it's better to, let the stock stabilize for a bit, maybe spend some time around the 750, 700 zone. And once that is done, I think there's some kind of a recession can be expected. But I think momentum traders should primarily focus on the power financing companies. This is exactly where, the momentum is there. One stock that we like from this space is on the railway finance side, which is IRFC. In fact, this stock has been sideways for many weeks now, and now considering the last 3 to 4 days of action, this is indicating that a triple-digit move could be on the card. So we're expecting around 100, 105 to be tested anytime soon. Can be bought with a 7-8% stop loss as per yesterday's close. And this is one of those stocks which is right there on the top of our buying list.
Rahul, what's your Nifty trade this morning? We are looking at a start closer to 21,200. If we do get that gap up for intraday, would you, and this is intraday, would you go long or short? Or you do nothing?
It's a tough one. I mean, if you've carried longs yesterday, I think this is a good time to take profits and, wait for at least 15-20 minutes for the Nifty to stabilize. For a fresh trade, I think it's better to sort of, let the initial action take place, and post that we can take a trade.
Okay, and a large portion of that would be dependent on financials. So fundamentally, Devin, I'll come to you on this. Financiers, particularly power financiers, because they were the talk of town yesterday, but some of the others too. Do you have a constructive view there? And if so, fundamentally, which one is still, or which pocket still merits an investment?
So, yes, and Niraj, I think there is an argument for remaining strong on this particular space, largely because of the fact that on one side, the country is executing large-size infrastructure, be it in generation, be it in distribution of power. An IREDA kind of company, which has relatively come recently in the market, which is focusing purely on the renewable space of power. So as a government, I think instead of depending only on one balance sheet, they are creating significantly, I think, large balance sheets across, I think, 2 or 3 companies, which is REC, PFC, IREDA, and probably, I think, trying to give the maximum amount of thrust to this sector by giving the power of the NBFC funding to this sector. I would remain bullish about it. However, having said that, mindful about the situation that REC, PFCs are in a firm bull grip at this point of time, and from whatever the compelling low valuation at which they were quoting few quarters ago or a couple of quarters ago, compared to that, I think today they have reasonably reached to the scale. I think maybe somewhere around 2 times price to book value. I think they have already reached to that scale. Generally believe that infrastructure lending companies should be fair valued if they are around between 2 to 2.5 times. In case of IREDA, I think it is already on a future outlook basis also, I think it has already started putting it 3 times. So to a certain extent, there is an expensive element already entered into the stocks. However, having said that, the fundamentals remain convincing. So any kind of correction in the market price or a fall in the market price would demand buying again into this stocks in the portfolio.
Right. Devin, Rahul, just stay with us. Just a quick mention on the dollar rupee and the 10-year paper. The dollar rupee has seen a gap up. Levels of 83.28 is what the currency has opened at. More or less in expected lines. The trading range, I believe, for the day is anywhere in the range of 83.10 to 83.40 on the upside. We've opened up right in between. Wouldn't surprise me if there could be some intervention coming in from the RBI and they would try and defend levels, because you don't really want a sharp pullback, a sharp rally or a decline on the currency, and that's pretty much been status quo for the last couple of months. On the 10-year, we closed at 7.3 and we've opened at 7.21. So Tamanna, more or less on expected lines. This is more about dollar weakness as opposed to rupee strength.
Yeah, absolutely. But a good move up for the rupee after a while. So that indicates a good start there. But I just want to come back to the market play as we are seeing your opening rates settle, and we'll pull that up just for a sec before I go back to the Devin Joksi. And look at that, you're 21,110 on your pre-open already. So you're definitely up for a strong start. Sensex is 500, 600 points up in pre-open. Devin, by IT and financials, the story of the day, because IT stocks have been beaten down. And already, at least in pre-open, the trend is looking like they will be back in favor, perhaps on the back of some of the commentary that came from the Fed, pointing to a better economic outlook for the US, or are there other factors as well? What do you think about the space?
Well, Tamanna, absolutely. I think the IT remains the bet which one would not miss out, I think, at this point of time. Because in 2024, we are seeing significantly large amount of orders flowing into Indian IT companies. Those who have remained on the fence and did not allocate money in 23, I think, in the Western world, they are probably, I think, allocating more amount of money, I think, to IT companies today, largely because of the fact that the technology platforms are changing and dramatically changing. The adoption of AI, AGI is also, I think, dramatically, I think, asking for investing money into this space. So most of the global companies, apart from cloud computing, I think, are spending on new technology blocks, including in BFSI space. We are seeing the adoption of blockchain, which is also making a significant amount of sense as far as, I think, the larger order for the major companies are concerned. Having said that, we would still remain confident about the mid-tier IT company space and whether specialization in the engineering R&D space, and some of them which we mentioned earlier includes the likes of LTTS, LTIM, and even Cyient Technology, apart from recently listed Tata Technologies. So these are some of the companies where we remain distinctly positive as far as I think the growth outlook is concerned.
All right, we're going to take a very short break, and I'm going to come back and see on the charts what Rahul likes on the IT pack as well. But we're coming right back. It's going to be an exciting morning. Don't go away. About 2 minutes left for market open, and it's looking like an exciting start. How high are we going to open is the question, is the bet. And let's go across quickly before I come to Niraj on the wall to get last picks from Rahul. Before pre-open, Rahul, what would be your top picks right now?
Yeah, so I would go with the momentum boys from the IT pack. Two stocks which look very good on the charts. One is Coforge, can easily give a 7 to 8% up move in the next couple of trading sessions. The second one that we like is LTI Mindtree. Even that is poised for a breakout. Similar kind of upside can be expected in the same as well. So from the IT pack, LTI Mindtree and Coforge.
Wondering, Rahul, you're not going long on Nifty IT, considering you're liking all the IT names?
No, absolutely. I'm lock, stock and barrel long in Nifty IT. I think the next 3 to 4 months, we could very well see a 15 to 18% kind of an upside in the IT index. We are quite bullish on the IT space.
So,
no on dollar play?
Dollar play plus the China Politburo or the Chinese stimulus as well. The only problem is come in China, and there is some major cold wave in northern parts of China, including Beijing. And if that thwarts the recovery of China, somehow China would have the largest play on the metals, but it could be an interesting pocket. We'll talk to Devin about that, Samina, for sure. But 45 seconds left. Just want to quickly mark Fusion Micro as well, because the large block deal that was anticipated to happen this morning has happened, and the stock is very likely going to start off about 5% higher. We're waiting for the clock, I know, but can we just pull up the stock price of pre-open rate of Fusion Microfinance here and just show you that 1 crore shares have changed hands. That, if I'm not wrong, is a sizable part of the equity, and that the stock in the pre-open session is showing an uptick of about 5% odd. So that's certainly one mid-cap stock that will be in focus this morning. That's Fusion Micro, 591 on significantly higher volumes done on the block side. But the market's about to kickstart trade. We will have a gap up about 200 odd points. The question is, can we build on from there? Let's get the heat map up on the screen and show you what's moving and what's not. So about 180 or 170 points for the Nifty. The Sensex 0.8% too. And the bank Nifty, that's strong, nearly 1% for the Nifty bank. Mind you, the FTSE rebalancing tomorrow, $450 million worth of inflows expected in HDFC Bank. So financials would be active. Mid caps start about 0.8% higher. Small cap index, 0.8% higher too. And remember, the small caps ended 1% higher yesterday, even if the Nifty was flat. So that's first part of the conversation. Now, let's pull up the heat map and show you what's moving and what's not. Can we get the heat map up on the screen? There is strength in IT. Well, HCL Tech, Wipro and Tech Mahindra, all three within the top 5 gainers list. So what Rahul was saying turning out to be true. Samina pointed out metals. We are seeing strength in Hindalco, so that's starting off well. Not seeing too many others there, but very likely that those two. And one of the reasons why the Nifty and the Bank Nifty could be doing well is because of this boy here. Okay, it's moved into the top 10. HDFC Bank, 1.2% higher. Essentially, a large screen of green, very little red, maybe an odd power grid down in the session, and that's a surprise really because all the power related names have done very well. But today could be the day of the stocks which come out on the front foot and hit the ball for a 6. The heavy lifters, the fast movers would be in focus, and giving them company would be information technology. Can't take my eyes away what's happening in IT because TCS has joined the party now with 1.78% gains as well. Clear favor of IT. No doubt that the index is doing well because it's not banks but IT powering, and banks are yet to show their power. Tamanna, great start. What's happening at the broader end of the spectrum?
You know, I just want to talk about SBI for just a second, and yes, that's on the heat map. We're going to focus on some of the stocks we talked about this morning, and of course, this is going to be that kind of market where there are more positive stories than negative. But SBI, because the lender is signing a 70 million euro line of credit with KfW, although all financials are up, that Bank Nifty is looking beautiful this morning. IRCTC, we spoke about that PSU play continues to really excite the market, and IRCTC, because they're moving beyond just catering for the railways, the stock up 2% in trade. Religare, let's see if bad news has affected or impacted Religare on a market like this when the mood is pretty up, and no, not really, 0.5% up, even though SEBI has suspended the company's Religare commodities unit for 3 months. Biocon, let's just look at what's happening to Biocon. Pharma not really participating so far in the rally today, but Biocon's subsidiary had a bit of news there, and Biocon is mildly down, actually flat right now as we speak. But Fusion Microfinance, that's something we talked about as markets opened as well, and that block deal news did come in. Fusion Microfinance is off to a flying start, up 6% in trade because a 9.25% stake sale has taken place. NBCC is another one I want to see. It had orders, 1,500 crores, which was announced. That stock is up about 5%. It's going to be making warehouse and other agri-infra. RBL, let's just look at RBL. It's acquired an 8.5% stake in ONDC. So RBL, with all the other banks, what's happening there? Nothing too much on RBL side. And GMM Pfaudler, something which Samina pointed out this morning. It's not been doing too well overall, but today GMM Pfaudler is having a pretty decent day. Samina, overall, though, you would say that the story is about IT, maybe metals?
It's looking really good, Tamanna. The breadth of the market's looking solid. So you've got about 177 advancing stocks and only about 22 declining counters and 2 unchanged names. Tamanna has indicated IT was a sweet spot and continues to look really good this morning. The Nifty has opened above levels of 21,000. The Sensex also looking comfortable above 70,000. A few other names from the broader markets that are seeing traction this morning. So Adani Green is up 5%. Emphasis from the mid-cap IT pack is trading with a gain of 4%. Coforge, it was a counter that Rahul had also recommended just before we went into market opening, trading with a gain of 3.5% as well. Persistent is trading with a gain of 2.5%. Tech Mahindra is up 2.5%. So across the broader markets or mid-cap IT, the gains are anywhere in the range of 2 to 4% each. Let's take a look at KPIT as well as while we're at it. Tata Elxsi, Tata Tech, KPIT also doing well, 2% higher. Tata Technologies, Tata Elxsi should be the other two names for the IT pack that should be having a solid day of trade. HCL Tech also trades with gains of of 2%. Infosys, which is already behind highlighted in the large cap space, is having a good morning too. Across the metal universe, SAIL is looking good. 2.5% gains on SAIL is what I'm picking up on. Jindal Steel is up 2.5%. Remember, metals have been doing well for the last few days. The rally continuing this morning on back of a weaker dollar and recovery that we're anticipating in the US. So largely speaking, the whole metal pack is shining in today's day of trade. You've also got tire companies looking good, so stocks like Apollo Tires are up 2%. You've got Yes Bank, Lodha, we've talked about KPIT, Paytm, Adani Ports. The whole Adani pack, including Adani Ports, Adani Green, Adani Enterprise, are all trading deeply in positive territory. We've highlighted the gainers for you, but let's quickly take a look at stocks that are actually losing. Mankind Pharma, there was a block deal on that one. The stock is down 2%. Power Grid, Maxell, Bajaj Holding, Nestle India are some of the counters that are trading soft in early morning trade. But all in all, the setup looks really good. The bulls are very much in control of this trade. The Nifty, the Sensex, the breadth, the broader markets all trading deeply in positive territory. Rahul, Coforge was a buy call you had this morning for our viewers. It has got a gap up, trading with a 3% move already at 5,988. Is there still an opportunity to buy?
Yeah, absolutely. I think if we slightly zoom out and see the kind of structure that this stock has formed, technically this seems like another 10% up move can be possible from here going ahead in the next maybe couple of weeks. So, from a positional perspective, this looks pretty solid. Can be bought at these levels around 5,700 stop loss, and I'm expecting 6,500 plus kind of a target, in the short term. So, IT stocks have finally, got the trigger that they were looking for. The IT index is poised very strongly, and Coforge remains one of our top picks to play this breakout.
Deven, I want to come to you to the kind of morning we've seen, kind of opening we've seen, and just a quick word of some absolute whoppers. Tanla platform. I just want to pull that up because that stock has been on fire since yesterday. It's up 7% in trade right now. Birlasoft, Brightcom, some interesting ones. But Deven, my question to you is essentially on what do you do at this point? If you have money sitting on the sidelines and you were waiting with some dry powder thinking that let this Fed business get out of the way and then I'll figure out what next. Are you getting an opportunity in this market, or do you have to cross your fingers and wait for the next sort of downtick?
Fortunately, I think this market is offering opportunity in some of the large cap names. I think they are index names. Whole 23, calendar year 23, almost I think has not worked good for many of the large cap names, including the likes of Infosys, including the likes of NDTV Bank, including the likes of Reliance, for that matter. Whereas we believe that the fundamentals of these companies are absolutely convincing and strong. And the very fact that they are not appreciated, I think that is all the more reason for buying them now. Because on the other side, you are seeing the flow of money coming into the market through index funds. These index funds, I think, are likely to take a higher amount of exposure to India market vis-a-vis what they did in 23, in the calendar year 24, largely because of the fact that some of these heavyweights, I think, who are performing well on the business side, are not participating in the market. So the exposure is likely to increase on that front. So tailwind is already there as far as I think the market outlook on this stock is concerned. So both fundamentals as well as the liquidity, both are supporting some of these companies. So we believe that I think these are opportunities along with some of the heavyweight names like Jio, FinServ, where probably we are seeing the higher amount of growth going forward in the business for this company. So certainly selective investment opportunities around, and I think one would not miss them. Including some of the contrabats in metals. I would think that I think though commodity is always unpredictable, but given the structural change which is happening in metals, on one side we are seeing the lower cost of crude oil, and on the other side we are seeing the adoption of green hydrogen, which is structurally beneficial to many of the metal companies going forward in the next 5-10 years. So one would remain bullish when the opportunity comes right. I think this is the time when probably one can create a long position on some of the ferrous and non-ferrous metal portfolios, given the fact that the consumption is increasing largely because of the changes which are happening in the environment for adopting the zero carbon policy. So we are remaining bullish on this particular space as well.
Deven, for the sake of our viewers, can you be a little break that down for us, a little more specific in terms of which metal stocks you'd be looking to buy right now?
So comfortable buying into Tata Steel, comfortable buying into Hindalco. Both these companies, I think, are remaining relatively more stronger. The government-owned Hindustan Copper also remains, I think, one of the better bets going forward. The outlook on coppers, given the kind of requirement on the electricals and electronic sides. So from that perspective, I think these three companies remain absolutely convincing from investing into metals. The Vedanta would have been bought, but given the fact that I think they are struggling with the restructuring of the group and all, I think that is where probably I think their stock may not find a tailwind. But the rest of these companies probably may be beneficiary at this point.
Fine. Okay, just keep in mind, I just want to take into account what some of the big movers from yesterday's session have done very quickly. So, or the last few days. So, PI Industries was down and out 2 days on a trot. Is the market recovery helping that stock a little bit? A wee little, so nothing too dramatic, but yes, doing well. So that is a good thing. PFC, REC, we've spoken about them ad nauseum, but the other two, which is Inox Wind, which went up in trade, Inox Wind and Inox Wind Energy, a bit sedate this morning, and maybe good to see some bit of gravity there. So that is part two. By the way, between Inox Wind and Inox Wind Energy, viewers, there is still a 22% arbitrage because there is a merger announced which will get consummated in 3 or 4 months. So that's to be kept in mind. And Nifty IT, a super move, because if you look at the broader end of the spectrum, yesterday we highlighted some delivery-based buying seen in Sonata Software. That is top of the pile when it comes to the BSE 500 gainers, but the others like Emphasis, etc. also are giving company. We know, Rahul, that we've asked you for your stock ideas early morning, but 10 minutes or 12 minutes into open, is there something, before we thank you, is there something that is standing out which you think you would want to initiate a fresh trade on? It could be a positional trade too, by the way.
Yeah, so from a positional perspective, we feel that IRFC looks pretty solid at these levels. One can look to buy at the current price of 86.5, have a stop loss placed at 80, and I'm expecting 100, 105 to be tested anytime soon. So a breakout trade, we've seen the other finance companies do very well. We're expecting similar kind of action in this one as well. So one can look to buy for delivery for like a 10 to for 4 to 5 weeks kind of a time frame, and one can expect like a 20% upside from current levels.
We really need to slip into a break, but Deven, can't let you go before talking about the Adani Group stocks as well, because when the market is in such fine fettle, some of these stocks, the Adani Port yesterday was knocking on the doors of 1100. GMR Airports having done what it has done, there is clearly tailwinds for various businesses of enterprises as well. So just trying to understand, any thoughts on the Adani Group stocks?
Fundamentally, we remain absolutely bullish, Niraj, on Adani Group stocks, largely because of the fact that 60,000 crore EBITDA producing companies, I think, in the group is basically growing at the rate of around 20%. So that gives us a visibility of doubling the group size in 3.5 to 4 years' time without any inorganic growth and without, I think, taking into account the organic expansions into the business. This is where I think the utility businesses, annuity businesses come into play, and they give fantastic amount of visibility of earning to some of the funds, including insurance funds, pension funds, sovereign funds. And that's where we believe, I think, that they will be in a position to attract more amount of money, given the kind of rollout of expansion that they are doing. One would remain selectively bullish on respective companies. Of course, I think they move much faster compared to market. They assume super beta as far as I think their speed is concerned. But we remain, I think, selectively bullish about the group companies within Adani. Adani Port remains absolutely very convincing story, given the kind of volume that they now have for more than 500 million metric tons of cargo handling capacity already in place. We believe that I think this is remaining, I think, one of the very stronger bet going forward.
Rahul, very quickly, Deven, of course, is constructive on the Adani pack. Any of those Adani stocks you'd be looking to go long on for the series?
Yeah, so two stocks look good. One is Adani Ports. Clearly, the stock is leading the entire pack. Won't be surprised if it moves up another 6 to 7% in the very short term. And apart from that, cement has started seeing strength coming back, and the likes of Ambuja and ACC, both of them have sort of, very strong setups on the charts. I would go with ACC as of now. So ACC around 2200, the risk reward is good for a fresh breakout. One can look to buy, have a stop loss placed at 2040, and a possible 2350, 2400 kind of a target can be expected by the end of this series. So ACC and Adani Ports are our top picks from the Adani pack.
Rahul, Deven, thank you so much for taking the time out and being with us. Really appreciate your time this morning and have a great day. A standard disclaimer, of course, viewers, that the Adani Group owns NDTV and NDTV Profit is the part of that bouquet. So just wanted to lay out that disclaimer. Need to slip into a break. Up next, we get in Mihir Vora of Trust MF. He's got an equal eye on both the macros and the micros, which is equities, and we'll get him in our studios to try and get his sense of what's next.
back to India Market Open. Let's take a look at the top headlines that we're tracking this morning. Markets open at fresh record highs. Nifty trades about 21,000. Sensex trades above 70,000. All sectoral indices in the green. The US Fed keeps the policy rates unchanged for now, but indicates there will be 3 rate cuts of 25 basis points each in 2024. And oil prices recover on bigger than expected weekly withdrawals from the US. Crude storage, US inventories fall by 4.3 million barrels as against expectation of a decline of only 650,000 barrels. Nifty IT reverses yesterday's losses to become the top gainer this morning. Emphasis go forward surged the most. And from the COP28 summit, after a dramatic gridlock, over 200 countries finally agree on an historic resolution to transition away from fossil fuels. Well, we have with us a very special guest. Mihir Vora, CIO of Trust MF, joins us. Mihir, you track global, local, macro, micro. Today, of course, the big reaction globally is on what the Fed chief has done or not done. But the commentary is what the markets are reading into. Do you think all of this is already baked in, and today's rally could be the start to the markets now taking a breather from all the euphoria we've seen, not just now, but also in November?
No, I think it's been a series of incrementally pleasant surprises, I would say, over the last few weeks. And the developments and the commentary from the US markets is increasingly dovish.
Correct.
So I don't think it's the end of the dovishness, probably, because we were quite hawkish till about 4 or 5 weeks ago. But now the inflation expectations are coming down sharply, and US growth seems to be holding up better than expected. So, that's incrementally much more benign scenario for India, the dollar, etc. So to that extent, we may not have fully baked in the positiveness, I would say.
I have a quick follow-up on that, Mihir, and you said that we are seeing growth in the US, but from all the data we've picked up on in the last few months, real rates have been impacted. So if you look at mortgage loans, auto loans, business loans, all of that have gotten expensive. Those industries have actually shrunk. So contrary to the headline number, which looks better than expected, the real economy is struggling. Now, this is where I'm a little confused, right? You're holding off on rate hikes because you think growth is doing okay, or do you actually fear a recession? This is a tightrope to walk, because I know the likes of a Goldman have actually pulled the Fed chief down, saying it would be nicer if he had pushed back on these rate cuts.
See, the point is, the Fed is focusing on inflation. And the peak of the inflationary expectations is already past us. So the 10-year bond yield, like a few weeks ago, was 5%. It's already close to 4% now. 4 now, yeah, right? So to that extent, the markets are always forward-looking. And you talked about mortgage rates. They will also follow suit in due course.
And you don't think any of this is because of elections next year?
See, the US fiscal deficit is out of control. So that problem has not gone away. And the Biden administration seems to be going full-fledged on fiscal profligacy.
Yeah.
So the birds are going to come home to roost. But the point is, as long as you can keep on postponing it, they're going to do it.
It's going to work.
Yeah, that's a pre-election sort of a mantra that you
it's almost like India.
I think
not as certain as India.
All politicians have the same problem, but in the Indian context, in fact, we have seen this extra spending going out of the equation when it comes to politics, which is, of course, a discussion for a different day. Today, we're going to focus on the markets, and for our viewers right now, seeing you in the studio is fantastic, because they're hoping for insight on what to do right now in a market like this. For the faint-hearted, the levels this morning, after the run-up we've had, can be a bit nerve-wracking, because you're wondering, now what? Do I just sit on the sidelines, wait for the next opportunity? Do I come in aggressively? If I do so, then where?
Sure. So first of all, for India, it's turning out to be a Goldilocks scenario, right? Where large cap valuations are expensive, but not still in bubble territory. Mid caps and small caps underperformed for almost a couple of years after COVID, but now in the last 12 months, they're catching up and maybe even extending their rally a bit more than expected. So I think the domestic theme and the backdrop for domestic growth is good. The only weak spot seems to be the lower end consumption, the rural economy, which is the only weak spot, I would say. But if you look at the higher end consumption, corporate sentiment, the overall, I would say, urban rich class sentiment is quite positive. And the hope is that once that consumption continues, the lower end also should pick up, because in election year, we do expect some kind of support for the masses. We just got a few more months to go. So we will see some support in terms of MSP and other measures for the rural economy. If the investment cycle continues the way it is, I think we are still in for good times.
So, an interesting point there, because in a market like today, FMCG is not firing the way everything else.
Because that's the rural and the lower end consumption.
It's a banking, reality, and of course IT kind of.
Even in reality, the higher end houses are selling more than the affordable housing.
More passenger vehicles, four-wheelers than two-wheelers. So that story continues. But as a play right now, and especially when you're seeing mid-cap, smaller cap counters suddenly spiking on news stories like QIP, etc. For individual investors, is it now the time to look at the good old big boys, as they say in the market, big boys / girls, your large caps, and then start betting on those to now catch up?
Certainly, if you look at the aggregates, the large cap indices definitely look more reasonable than the mid and small cap indices. But the thing is that for mid cap is okay, maybe 150 stocks, but the small cap tail is very long. And if you want to participate in any of the upcoming and emerging sectors, you don't have a choice but to be in the mid and small cap space. For example, if you are still bullish on the macro story on manufacturing, which means cap goods or construction, most of them are mid and small cap companies. Railway, for example. I mean, now, of course, most of the stocks have gone up. But if you want to participate in that sector for the longer term, you don't have a choice in the large cap. So I think it should be, I would say, a flexible approach. And so large caps, of course, should form a core of your portfolio. But you can have some specific stock picking in the mid and small cap segments.
Are you constructive there on the pockets that you just mentioned? Because there has been a bit of a rally.
Certainly. Because, again, the segments that we are talking about are segments which probably were not in the limelight even till 2 years ago, right? And these are all based on government push, PLI, defense, railway, road building, and that's going to continue because infrastructure creation is, I think, now happening on a bigger scale than before, and private sector is also waking up in terms of investments. So these themes we haven't played since, say, 2010, right? Because from almost 2014 to 2020, it was mostly consumption and quality and those kind of stuff. The cyclicals one really did not play. It's only started in the last couple of years, so I think it will last for a while longer.
There is also a belief, and I think we've spoken about it, that if 2010 to 2020 was a decade of B2C and consumption, is this the decade of B2B, manufacturing-led, CapEx-led, infra-led? And does this, if therefore this is a multi-year theme, would you be sanguine about paying a premium on the current valuations because the growth has such a long tail?
Absolutely. You don't have a choice.
Why do you say that?
The point is, look, the government's objective is to grow at 7% or 8%, not at 5%. You can only grow at 5% if you're depending on consumption. Right? If consumption cannot take you more than 5 and 5.5%. If you want to grow at 7 to 8%, it has to be investments-led, investments in manufacturing capacities, investments in buildings, etc., investments in real estate, and all the large infra that we require. So that 1 or 2 extra % has to come from physical asset creation. It cannot come from services or consumption. So if that's the long-term plan, I think we have no choice but to be in these physical asset creating segments.
Mihir, as a fund manager, what is your strategy for seeking alpha now? Would you go after mid-cap IT? That could be a space that's largely under-owned. Of course, after looking at today's rally, that story might be different. But where would you be seeking alpha for your clients?
Within IT or in general?
In general.
See, in general, as I said, I would not really look at stocks as per market cap criteria. The fundamentals and the approach remains the same whether it's a large cap or a mid cap. You look at growth and the longer term growth prospects, you look at valuations, whether it's mid cap. Of course, you want to do some kind of risk control because smaller stocks are not liquid. No, they're more volatile, more liquid. So at the portfolio level, you would do your sizing, bet sizing, etc. in terms of exposure. But stock picking approach and philosophy remains the same whether it's a large or a mid cap.
And where are you seeing that value still? Because we've seen such a sharp run up, right? I mean, finally, I know earnings season is expected to be good. Valuations, like you said, are expensive but not frothy yet. you've got
on the
large cap
yes.
space. But even if the emerging market back valuation is still below your 50-year average, so we may be not looking very attractive, but it's not too bad in that sense just yet. Where is new money going to find a place? Where will this fresh flows come in, go in?
See, I think there is enough value in certain pockets, for example.
Which are those pockets?
Say construction companies, right? Most of them are mid and small caps, right? And the kind of growth that one is envisaging in these segments, I think it should be a pocket of value. I don't think bubble valuations have reached. They are not trading at 30 times or 40 times, right?
Yet.
Not yet. So that's one pocket. Pharma companies, for example, we've had a 5-6 year of underperformance in the pharma segment. Now it looks like the global generic markets probably would have bottomed out in terms of pricing. So you can find some pockets of value there. Power sector, for example, we haven't seen any action in the power sector for many years, and now we are talking about large investments in T&D, infra. Some of the multinationals have become expensive, but then a lot of the stocks are still not that expensive. So there are pockets to pick and choose from.
You were constructive on chemicals, by the way. Sorry, just that one question.
Yes.
On the same theme as well some time ago.
Yes.
Still constructive there?
Yes, chemicals, because again, after the euphoria, in the last 1.5 years, they have corrected significantly. Most of the companies have put up good capacities, or the capacities are coming up in the next 1 or 2 years. So there I would not bet on margin expansion, I would bet on volume growth, because the capacities are already there and being implemented as we speak.
So Mihir has quoted a Charlie Munger quote in one of his recent tweets, wherein he says, all intelligent investing is value investing, acquiring more than you're paying for. You must value the business in order to value the stock. So his takeaway from that is that many confuse value investing with investing in cheap stocks. That may not necessarily be the case.
Absolutely.
Having mentioned what is not cheap or definitely not inexpensive, I want to get your view on the whole financials and banking space, which is red hot. But within this, what? Private, PSU, do you look at what these banks are lending in terms of bet on green, renewable? Are you looking at those which are going lower credit or more retail mass? How do you sift through all of this, and what do you like here, Mihir?
Sure. So again, I would look at the individual financials separately, but for brevity, I would say that post-COVID, from the bottom to about last year, it was all led by private sector banks.
Yeah.
Even NBFCs underperformed, PSU banks underperformed. In the last 1 year, we've seen the PSU banks catch up in terms of valuations, because the difference between the performance of PSU and private sector banks had become just too stark. And of course, PSU banks had also cleaned up the balance sheet, etc. So there was a valuation catch up to be done. Balance sheets were clean enough, so we saw a big catch-up in the PSU space in the last 12 months or so. Similarly, NBFCs had also underperformed. Once we started seeing the peak of the rate cycle, NBFCs again outperformed. But there was a bit of a scare in the middle where we saw deposit rates going up in the last few months, and NBFCs probably have corrected a little bit. But I think now that we are again past peak hawkishness, so to say, by the RBI, even NBFC's cost of funds, etc., should do well. I would stay away from banks which are or NBFCs which are too concentrated in the retail space, because RBI has shown some red flags. I don't have data to feel otherwise, but if RBI is seeing something, I would just be a little more cautious there.
Right. Mihir, just a little more macro question, because of course the big story this morning is also what we've seen on the 10-year. Amid everything that's happening globally, locally, what kind of an asset allocation strategy can help a retail investor balance risk and return at this stage?
Sure. So, again, 3 years ago or 2.5 years ago, equities was a no-brainer in terms of asset allocation, because valuations were cheap and we were at the bottom and just bouncing back. And RBI was cutting rates and had already cut rates, so bond had already rallied.
Yeah.
But now we have seen RBI hike rates. Bond yields, which had almost touched 5.5-6%, are now at 7.2, etc. on the 10-year. And equities, as you know, we are of course a little bit concerned on valuations at the overall level. So right now, I would say that equities and bonds look equally attractive compared to completely equities, which was the view about 2 years ago. So one should look at some asset allocation to fixed income also, because
And when you say some, I mean, this is for an average profile risk investor, right? Average risk profile investor. How much of your asset allocation would you still give to fixed income? Because if you've already seen yields of 7.2, fresh money again coming to bond market, is this a good time?
It is, because
best time, right?
Best time, right? Yeah, if 7.2 goes to 6.5,
you're in the money. But there are also people who've gotten in at higher yields than 7.5. So those, of course, are sitting on a good M2M.
See, the asset allocation call will be a function of your personal risk profile, absolutely, age, etc. You know.
Yeah. And equity still looks very constructive, even from a
for the long term. Absolutely, equities makes absolute sense for the long term. I don't think anybody should discontinue their SIPs or insurance premiums or whatever, because I just kind of looked at the data, and even if you had invested at the peak of all the cycles, at the peak of the Nifty in 2008 or 2000 or say 2018-19, you would still have made 8-9% over the longer term. If you had caught the bottom, you would have made 15% CAGR, which is huge. But if you had caught the peak and held on for 10 years, you still made about 8%, which is not too bad.
And also in fixed income, would you go after long-term paper?
As of now, yes. As of now, I would be longer on duration, yes.
Okay.
I just want to
get you play duration. Sorry, yes. I'm just trying. Sorry, go on.
No, I just want to get a sense, Mihir, because if you look at the fund flows over the last few days, and FIs have been consistently buying, there's some selling from domestic institutional investors, and I'm just trying to understand if there is a thought over there, because you also have a lot of retail investors or SIP investors, mutual fund investors, who are expecting to see at the end of the year a good sort of a number on their returns. And do you think that kind of an idea is there, that where in select pockets it makes sense, it's time to book some profits?
For SIP investor, booking profit doesn't make sense.
No,
right?
for mutual funds or for fund managers.
So you're getting 17,000 crores of SIPs every month. I mean, even if you don't invest it, you're still sitting on a lot of cash, right? Forget about booking profits. It's a problem of plenty, and the way the momentum of the market is, I think it'll be a very brave fund manager to sit on large amounts of cash at this point in time.
Absolutely.
Sorry, just my last question, at least from my end. Mihir, since you talked about decadal themes, I'm just trying to understand, where is it that you believe you have the highest visibility of strong growth for the maximum time duration possible in this decade? Is it infra? Is it capital goods? Is it something else?
See, first and foremost, it has to be financials.
Highest visibility.
Because credit growth is typically 1.3, 1.5 times GDP growth. So it's a leverage play on the growth story. Right. So that's number one. And then, of course, all these physical asset creation stories.
But financials top the list.
Absolutely.
Okay. Great. Mihir, on that note, we'll let you go. Thank you so much for being with us in our studios in our opening week. Great to have you.
Thank you. Pleasure to be here for the first time, and all the best to all of you.
Thank you so much. Well, the market's in fine fettle, but we need to slip into a very quick break. Keep in mind that we're doing okay for now. Let's see if it holds out through the day. Back with some corporate conversation on the other side of this very quick break.